Hey, what's going on with the Arizona real estate market? Let's talk about it. Stay tuned. You're listening to Financial Sense, Arizona's financial podcast that gives you insights that you could only get from a friend in the business. Recorded and brought to you by National Bank of Arizona, the only bank you need. Hello, I'm your host, Brent Cannon. I'm the Director of Community Banking here at National Bank of Arizona. Thank you so much for joining us in our new season of Financial Sense. Today, we're talking about real estate in Arizona. Well, we're talking about it as well as everybody else. And joining me is Greg Hague, founder of 72 Soul.
Hey, Brent, thank you. Appreciate you having me on the show.
You bet. Glad to have you, Greg. And Mitch Gutierrez, a mortgage lending officer here at National Bank of Arizona. Welcome, Mitch.
Hello, Brent. Thanks for having me.
So, Greg and Mitch, on this podcast, we like to give people insights that they could only get from having a friend in the business. With that, our subject today is the real estate market in the residential real estate market in Arizona. So, Greg, I'll start with you. Why are we in this market? What's kind of driving the appreciation and these kind of what I would call a sticker tag shock from buyers and sellers counting all their dough? I mean, why?
Great question, and interesting. In its simplest form, it is supply and demand. And as interest rates have fallen over the past few years, that obviously has created huge demand for housing. Back in 1981, I remember when interest rates, truly 18%. And to me, I've always felt like a 6%, 7% rate was kind of about right. That was pretty normal. And something below 6% was like, wow, that's right. 5 point something. That's amazing. And, these historically low interest rates obviously make homes more affordable. And that has driven huge demand for properties. Then the other thing, it's interesting that I think a lot of people don't know is what else has driven demand for property. And that is the demand by institutional investors for rental. So right now in Arizona, it's estimated that 20 to 25% in some areas of the homes that would normally be purchased by you and me for our family, that they're being purchased by investors for rental. So that has added a component of demand that we've not previously had in Arizona or in this country. And some of those investors are major institutions, corporations that are accumulating thousands of homes all over the country because they view an investment in real estate to perhaps be better than stock or other areas. So we have two big components. We have the normal person, the family that would buy, and that's being driven by low interest rates. And then we have the institutional investors, and that's a new type of demand we've seen over the years. So that is creating huge demand on the market. And then on the supply side, we've obviously had, you've heard the old, now it's a cliche, the supply chain issues. So you have the supply chain issues, which are continuing to inhibit the number of new homes that can be built. And then a lot of people refinance their homes when interest rates were down around 3 or even below. And they are reluctant right now to sell because interest rates are a bit higher. Those factors are causing a massive imbalance with very low supply and very high demand. And that's a problem that I don't think is going to go away anytime soon.
It's really the perfect storm, isn't it? I mean, when you kind of look at this market, and I look at it a lot, I look at it and all these factors contribute, and it's really, perfect storm keeps coming to my mind. Hey, Mitch, in the last couple of years, I'd like you to kind of talk about the listeners. I know folks that have refinanced or purchased money in buying. From your perspective in the industry, I know there's been challenges. Share some of kind of volume, what you've seen in the last couple of years due to this interest rate environment.
Yes, absolutely. We've seen a big difference in applications coming in, purchases, for sure, refinances. A lot of people taking advantage of the lower rates, but those are starting to taper off now, as Greg mentioned, that the rates are starting to increase a bit. But I want to go back to Greg's point on the inventory. So what's really picked up in the past couple of years is construction lending. So as you may or may not know, the bank does offer a one-time construction loan program, which is very competitive, great program. And I've seen probably triple the volume come in for that product. And I just see because of the inventory being so low, now people are like, okay, there's not houses available for me to buy, so why don't I just go buy my own? The other side is, with COVID, you had people sitting in their houses and working from home, staring at the walls. And I think that that caused a lot of people to look around and say, you know what, we need to do some renovations. So a lot of people also doing, cash out refinances and the construction lending as well. But I do see the refinances tapering off, but purchases and the construction lending, I mean, those are still great rates right now, even though they're talking about them going up. I'm sure we'll get into that here in a bit. But yes, definitely business has been absolutely nuts for the past couple of years.
Let's do some prognostications here on the interest rates. First of all, what's your opinion? I think I probably know it, but Fed's talking about moving rates, probably 3 times, maybe 4, but probably 3 times this year. How does that affect mortgage rates for especially the non-banker real estate agent? How does that impact the mortgage rates? What should they expect?
Well, I'm not in Washington. I'm not in office. I'm not a politician, and I'm not with the Federal Reserve. But here's what I think. with all those disclaimers, here's what I think. Number one, I think that we'll call it the government, the Fed, sees inflation as a problem. So we've got inflation in a variety of core areas like food and gasoline. So how do we solve that? Well, we call home price increases appreciation.
Right.
Wow, that's great. Home prices, if you own a home.
Yeah.
If you don't own a home, it's a problem. If you do own a home, it's great. Price of my home's going up. I'm getting great appreciation. The Fed sees that as inflation. And housing right now, the price of a home is probably the single biggest inflation factor in this country.
Right.
So I predicted this months ago. There's no question anybody in my industry saw it coming. The Fed is going to keep pushing up rates. They have to. Right. They have to do that. They have to slow down this market, the housing market. But here's what they're missing. You want to know what they're missing?
What?
This situation has never existed before. And because they're not in real estate, I don't think they're seeing something. You see, what normally would be the case is if you crank up interest rates, that lowers demand. Lowering demand is going to temper inflation in houses. In other words, homes won't shoot up as quickly in value. That's the simple equation, always worked in the past. I don't think it's going to work this time.
Why is that?
Let me tell you why. Because they'll crank up interest rates. So what will happen is as they crank up rates, nobody's going to want to sell because nobody who's got a 2.8% loan on their home is going to want to take one out at 5 or at 6. Right. And so when I say nobody, only people who just have to sell because they're get a job transfer or something are going to sell. So while the Fed will temper demand, sure, get it. What they're also going to do is make homes less affordable. So that's a problem. And the other thing is they're going to keep people from selling. And if they lower supply while they're lowering demand, all they do is raise the cost to own a home for those that have to sell and have to buy. And I think that's what's going to happen. I actually think the move to raise interest rates is going to backfire. And I think they're going to look back in a year and they're going to see that it did not decrease the appreciation or inflation in homes.
That's very, very interesting. It's a very interesting discussion. Mitch, what are your thoughts on the interest rate environment and the ultimate impact?
Yeah, so as we know, the Feds are going to be meeting up in March, and they're saying that they're going to increase rates. So, that rate could be anywhere from 1/4 to 0.5%. Now, this is on prime, right? And they're saying maybe 3 to 7 times over the next year. But what people don't realize is prime rate doesn't actually have a direct impact on mortgage rates. The way mortgage rates are based off of is the 10-year Treasury. So just to give you an idea, the 10-year Treasury today is 1.8%. Back in 2020, it was as low as 0.6%. And that's when you had the really low rates on mortgages. So do I see mortgage rates really fluctuating or increasing a huge amount? I don't. You just look at the inflation rate and the 10-year treasury. It really didn't. It did fluctuate, but it really didn't fluctuate that big of an amount where it adjusted rate. And I don't foresee that happening again this year. As Greg had mentioned, the other factors that are all involved there. So, yeah, maybe we're in the low fours. But back in 2008, when we had that last crash, we were at 4% back then. We survived, and everybody, thought that was the highest rates back then. Well, no, guess what? Back in the 80s, the rates were as high as 16 to 18%. So, but inflation at that time was 14%, the highest it's ever been in the history. So we're at 7%. We'll see if we can get that down, but. Yeah, I think we'll see an adjustment, but it's not going to be a huge adjustment that's going to cause people to say, yeah, I just can't buy a house. I can't afford it.
Well, those are great points. And your points really make, I think, Greg's points that, with the rate increase, we've seen probably close to 150-ish basis point increase in the last 12 to 15 months, and it's not slowing down. So due to those other drivers, full disclosure, none of the three of us are economists. We don't work for the Fed. We don't impact Fed funds rate, but it's interesting to kind of see how that ties to the mortgage rates. I think that's a big question for a lot of folks is, okay, the Fed's talking about bumping this Fed funds rate. How does that impact, the 10-year, or what is the mortgage rates based off of? So, Mitch, I think that was some very nice discussion and description. So I want to ask this. I think I know the answer, Greg. You've touched on it, but and I'll get a consensus from you both. But let's go over the next, say, 12 to 36 months as a time horizon. What do you see in the Arizona market in terms of supply, demand, appreciation, et cetera?
We're not economists. It's obviously guesswork, but it's educated guesswork. Bottom line is, I think we'll have continue to have a challenge for home buyers. I think there'll continue to be low supply, and I think we will see robust appreciation. I think people that have a home loan at 4% or 4.5% or 5% or whatever it is, I think they're going to have a home run when it comes to what they're paying for their loan versus what their home is appreciating.
Right. Yeah, that's a really good view. And longer term than that, when I think about it, I see the population projections, the growth in population projections for the state of Arizona, and I just can't fathom even a longer term than that 36-month time horizon. I can't fathom having enough supply to ultimately meet the demand. I mean, and that's going up 5 to 10 years.
I do, and I think that Arizona will far outperform the country. So when you see things softening up a bit nationwide, I think because of the desirability of Arizona, so many people moving here from out of state and the vibrancy of our economy, I think we will far outperform most other areas. So yes, I agree with you. I can't see any scenario other than something that's just unforeseen, a black swan. Right. That will keep us, that will hold us back in the foreseeable future.
I'm not as aggressive as Greg on the prediction of appreciation, although I do see appreciation, but not as aggressive as it's been the past, couple of years. Definitely supply and demand plays a factor in that. But with rates going up, I think that will slow down people buying just because of the value, the value of money. So, but again, I do see still appreciation happening. And we just can't deny that everybody wants to move to Arizona and they love you here. There's no wonder why that is, but, with the supply not available and people wanting to stay in their house at low rates, that is going to, create that appreciation there. But again, rates being playing an issue, a factor in that as well.
Yeah. So you see appreciation with some tempering and, for the listeners, full disclosure, we're not economists. That's three people's opinion. So, So it's it. I'd like to end the call on a kind of an upbeat. And Greg, I want to come back to an offer you made to the listeners that we could end the call with some tips for buyers in this market. So I'd like to open the floor to you to share some of those tips.
Yeah, my pleasure. And first, just a comment. I think we're all in agreement in terms of what lies ahead in Arizona. And I wrote an article that I think your listeners might find interesting. It's called Home Ownership for the Privileged, and it relates primarily to Arizona and also the tips that I'm going to give everyone in terms of buying a home. My luxury home company here in Arizona is Hague Partners, Hague Partners. They could go to our blog, Hague Partners blog, and find that. So tips for buying a home. Number one, access to inventory early. Connect with a firm that will do that for you. Connect with several. Number two, put up an impressive earnest money deposit. It's refundable if you don't get the loan or the inspection. Number three, have your listing agent, your buyer agent, get to know the listing agent. Number four, craft your offer so it's what the seller wants to see. And number five, have your lender go to bat for you. Have your lender really go to bat for you beyond a pre-qual. Those are the things, as I say, we sell 20, 30 homes a day here. And those are the five main things that help buyers win our listing agents over and end up winning our homes.
Well, I'll tell you, those are great tips. I'm personally fired up and ready to go buy something. So you've given me some great tips there. Thanks, Greg. I sure appreciate those. Mitch, regarding the loan side of the equation, Greg touched on a point you had made earlier on the loan pre-qual, but anything else that folks should be really paying attention to on the loan side at this time?
As Greg mentioned, pre-qualification is definitely something that a borrower needs to get up front. It's very advantageous when they're making that offer. And one of the things I want to clarify, so I'll get a lot of clients that'll come to me saying they want a pre-approval versus a pre-qualification. Well, and really the difference between the two is a pre-approval, you're providing all your financial documentation and an underwriter is actually reviewing that. But I just wanted to point that out. There is a difference between the two. But in the broker's eyes, when they're making the offer, as long as they see a pre-qualification form completely filled out, meaning that we have received and reviewed tax returns, bank statements, pay stubs, W-2s, things like that, that makes it for more of a solid and effective pre-qualification versus someone that doesn't review all those items. And we've done many of these deals, so we typically know what to look for. Especially in self-employed borrowers. This bank doing a lot of portfolio lending. We're not a stranger to self-employed borrowers. So that's probably a higher percentage of my deals that I'm working with. The other thing that Greg touched on is follow up with those agents. So that is something that I do, in my day-to-day practice when I have a purchase. As soon as we get that purchase contract, I'm reaching out to both agents to introduce themselves just in case they don't know who I am already. And letting them know that I'm here if they need anything. Also making sure that they know that, the loan status updates so that they know what's going on with the loan, that those will be sent out on this particular day. If there's any other day, they can request it at the time and we'll accommodate them. But again, I think that if you're communicating with the agents and with the borrowers, it makes it for a more successful transaction all the way around.
Mitch and Greg, I want to thank you both for sharing your time, sharing your expertise in the industry. I know our listeners, this is such an important aspect to all of our lives. I think this information is so important. I think our listeners are going to truly enjoy and learn from it, which, at the end of the day, that's really what we're hoping to do. As we said, we're trying to provide information that you can only get from having a friend in the industry. So thank you so much for joining Financial Sense podcast today. We appreciate it. And here's to a healthy, robust Arizona real estate residential market. Once again, I'd like to thank you for watching Financial Sense. Please be sure to check us out on your favorite podcasting platform or also watch us on YouTube.